Hi, good morning everyone. Welcome back to Value.Venture. Today, let us understand one of the most common questions asked by property buyers. If a property is valued at 1 crore rupees, will the bank provide a loan of 1 crore rupees? The answer is no. Property valuation and loan eligibility are two completely different things, and today we'll understand exactly why. A valuation report tells the bank what the property is reasonably worth as on the date of valuation. The valuer examines the property's location, area, construction, age, condition, access, approvals, marketability, and the prevailing market rates. Based on this assessment, the valuer arrives at the property value, but here is the main point: the valuer does not decide the loan amount. That decision belongs entirely to the bank. The first factor the bank considers is the loan-to-value ratio, commonly known as LTV. LTV compares the proposed loan amount with the property value accepted by the banker. The bank normally does not finance the entire property value. A margin is always maintained, and the borrower is expected to contribute a portion of the property cost from their own funds. This is your down payment. The second important factor is the borrower's income and repayment capacity. Even if the property value is high, the bank must check whether the borrower can comfortably repay the monthly installments. The lender considers income, existing EMIs, household expenses, business liabilities, and other financial commitments. Two borrowers offering properties of the same value may qualify for very different loan amounts, simply because their incomes and liabilities are different. The bank also checks the borrower's credit profile. A good repayment history and a healthy credit score support the loan application. Delayed payments, defaults, or excessive borrowing may affect the approval, the eligible amount, the interest rate, or the tenure. And tenure itself matters. A longer tenure reduces the monthly EMI, but the permitted tenure depends on the borrower's age, income continuity, retirement age, and the lender's policy. The property must also be legally and technically acceptable to the lender. A property may have a high market value but still be rejected because of title defects, missing approvals, major construction deviations, access problems, encumbrances, identification issues, or poor marketability. So value alone does not make a property suitable for lending. Let us take a simple example. Assume a property is valued at 1 crore rupees. If 80% LTV applies under the lender's policy, the property value may support a loan of up to 80 lakh rupees. But if the borrower's income and existing obligations support only 60 lakh rupees, the bank may restrict the loan to 60 lakh. And even with sufficient income, the loan may be reduced or rejected if the legal or technical assessment is not satisfactory. So think of it as 4 different questions. The valuer answers, what is the property reasonably worth? The credit team answers, how much can the borrower reasonably repay? The legal and technical teams answer, is the property acceptable as security? And the LTV policy decides how much the accepted value can support. The final loan amount is decided only after all of these come together. So remember this clearly, a high property valuation does not guarantee a high loan, and a lower loan sanction does not mean the property was undervalued. Another lending factor may simply have restricted eligibility. Valuation is an important part of the loan process, but it is not the final loan sanction. Please subscribe to Value.Venture for more informative videos on property valuation, home loans, mortgage finance, and real estate due diligence. Thank you for watching.